Hey there, and welcome to today's Explainer. Today, we're unpacking a seriously fascinating and honestly incredibly powerful option strategy used all the time in the Indian markets. We're talking about the straddle. Look, whether you're trading Bank Nifty, Fin Nifty, or gearing up for a massive RBI policy day, the straddle is, well, it's basically a psychological battleground. Okay, so let's just dive right into this, because what we're really talking about today is a total mindset shift. We're going to look at how smart traders actually step completely away from trying to predict market direction, and instead, they just trade pure movement. I mean, it's a super frustrating experience, right? You do all your research, you confidently pick a direction, buy your call or your put, and boom, the market instantly reverses on you. Guessing wrong is literally the most common way traders lose capital. But think about this. What if you just didn't have to guess the direction at all? What if I told you there's no need to know if the market is going up or down to actually win? That right there is the brilliant paradox of the straddle strategy. You aren't predicting if the index will rise or fall. You're simply predicting if it's going to move explosively or just do absolutely nothing. So here's our roadmap for today. We'll start with 1, the straddle foundation. Then we'll dive into 2, long straddle, buying uncertainty. And 3, short straddle, selling fear. After that, we hit 4, expiry traps and the Greeks, 5, adjustments and defenses, and finally 6, rules for straddle survival. All right, section 1, the straddle foundation, movement over direction.
So what actually is a straddle? Basically, it just means taking both a call, a CE, and a put, a PE, at the exact same strike price with the exact same expiry date. By taking both sides of the trade right at the current market price, you're completely throwing directional bias out the window. This whole foundation is built entirely on expecting an extreme. You are positioning yourself for either massive, explosive volatility where one side absolutely rockets, or complete, boring stagnation where neither side moves an inch. There is literally no middle ground here.
Moving on to section 2, long straddle, buying uncertainty, betting on the explosion. Let's think about the psychological profile of the long straddle buyer for a second. When you buy a straddle, you are quite literally betting on an explosion. You expect massive sweeping movement. This is your classic play right before major news events, things like an RBI policy announcement, election results, or budget day. You are buying uncertainty. But, and this is a big but, the immense risk here is a sideways market. If that index stays flat, both your call and your put lose value, and you end up taking a hit on both sides. Okay, let's put some real numbers to this with a Bank Nifty RBI policy day example. Let's say Bank Nifty is sitting exactly at 48,000. You buy the 48,000 call for 250 rupees, and you buy the 48,000 put for 230 rupees. So your total combined cost, 480 rupees. Now the absolute most crucial point here is your break-even hurdle. For you to actually walk away with a profit, Bank Nifty can't just move a tiny bit. It has to cover that entire 480 rupee cost. It's got to surge above 48,480 on the upside or absolutely crash below 47,520 on the downside. If the RBI surprises everyone and Bank Nifty suddenly shoots to 48,900, well, your call premium explodes, your put obviously falls to zero, but your net position is highly profitable. You successfully bought the movement. All right, section 3, short straddle, selling fear, controlling the range. So if the long straddle buys uncertainty, the short straddle sells fear. Instead of buying the call and the put, you're out there selling both of them at that exact same strike price. And the psychology here, it is completely inverted. The seller expects the market to remain perfectly controlled and range-bound. This is incredibly popular during a normal, quiet weekly expiry. Honestly, option sellers absolutely thrive when markets are boring. They collect all that premium upfront from the buyers, and as long as the market doesn't violently break out, they just profit handsomely as the clock ticks away. Now visually, this inverse relationship is super stark. Imagine a V shape. For the long straddle, your loss is strictly capped at the bottom of the V, which is just the premium you paid. But your profit potential shoots up infinitely in either direction as those lines go up and out. But for the short straddle, it's an upside-down V. Your maximum profit is capped at the very top, which is the exact premium you collected, but if the market breaks aggressively past those break-even points, those lines plunge downward forever, limitless downside risk. And yeah, that is exactly why selling straddles requires ironclad discipline. Next up, section 4, expiry traps and the Greeks, the hidden forces of options. Okay, let's talk about these hidden mathematical forces we call the Greeks. We really only need to focus on the 2 biggest players for a straddle today. First up is theta, which represents time decay. Literally, as every single minute passes, option premiums melt. Theta is the ultimate enemy of the buyer and the absolute best friend of the seller. Second is vega, which is implied volatility, or IV. When anticipation builds before a huge event, IV rises, making options super expensive. This actually helps buyers who got in early, but the very second that news is out, the uncertainty vanishes. This triggers a massive IV crush, which rapidly destroys premium value. It often leaves retail buyers holding massive losses, even if they actually guess the market direction right.
Picture this real quick. It's Thursday, weekly expiry. It's exactly 1 p.m. A retail trader sees the market consolidating and buys a straddle, totally expecting this massive afternoon breakout. But instead, the index just hovers in this tight, agonizing 50-point range. Welcome to the premium eating zone. Because there are only a couple of hours left until expiry, theta just goes into absolute overdrive. The premiums on both the call and the put don't just decay, they evaporate into thin air. Time kills way faster than trend in the Indian weekly expiry.
Section 5. Adjustments and Defenses. How smart money survives breakouts.
Here's the thing. Professional option sellers rarely just sit there and take a maximum loss. They adjust. If the market suddenly trends heavily in one direction, they might execute step 1, which is converting the straddle to a strangle. This basically means buying back the losing side and selling a new option further out of the money just to reduce that directional risk. Or, to prevent the absolute nightmare of limitless loss entirely, they use step 2, the iron fly. This means selling the ATM straddle, but simultaneously buying cheap, far out of the money calls and puts to act as wings. These wings basically work like insurance, strictly capping the maximum possible loss if some wild gap or breakout happens.
Final section, Section 6. Rules for straddle survival. Movement versus time. When you pull all these concepts together into a master cheat sheet for the Indian market, a massive overarching theme becomes super clear. The straddle strategy isn't just a mathematical setup. It's a literal battle of movement versus time and fear versus probability. Falling into psychological traps, things like overtrading or totally ignoring overnight gap risk, will drain your account way faster than a bad market call ever will. So the most crucial points really boil down to these specific survival rules. As a long straddle buyer, your absolute mandate is that you must enter before the implied volatility expands. If you buy right before an event when premiums are already sky high, that IV crush is going to absolutely destroy you. Just don't overpay. Now, as a short straddle seller, you've got to fiercely respect breakouts. You simply cannot have an unlimited loss mindset. You have to hedge your positions and be ready to adjust quickly if the market turns violent. It really all comes down to this ultimate psychological dichotomy. Retail buys premium for hope, smart money sells premium for probability. That captures the entire dynamic perfectly. Retail traders so often use the long straddle just hoping for a lottery ticket payout from some unexpected market crash or a massive surge. But institutions and smart money, they sell the short straddle based on the cold, hard mathematical probability that most of the time, the market just does absolutely nothing. Which brings us to our final principle to leave you with today. If you buy straddle, buy movement early. If you sell straddle, sell fear carefully. The straddle is a truly phenomenal tool, provided you know exactly which game you're playing. So the next time you face an RBI policy day, or even just a quiet weekly expiry, you really have to ask yourself, are you the one paying for a lottery ticket, or are you the one mathematically stacking the deck in your favor?